Joe Anderson and Al Clopine of Pure Financial Advisors have the answers to your retirement plan. This is your money, your wealth.
Since the beginning of the stock market, we've invested. The stock market goes up, the stock market goes down, and then it reaches new highs. It's going to continue to do this with your money. It's going to do it with your kids' money. It did it with your grandparents' money. It goes down, it goes up, it goes down, and then it reaches new highs. We know that this happens, but why do we continue to lose money in the market? Stick around, because it's your behavior. It's your emotion when it comes to your money, and we're going to tell you the things that you got to look out for to have a better investment experience. Welcome to the show, everyone. My name is Joe Anderson. I'm a certified financial planner, president of Pure Financial Advisors. I'm with the big man, of course, Big Al Clopine. He is sitting right over there. He's going to join us momentarily. We'll dig into Big Al's mind to see what he can do to help us with our emotion. We have a great show lined up. We have Allison Alley joining us a little bit later to talk about the emotion when it comes to investing. If you didn't know this, women are better investors than men. Figure that out. Now, when it comes to investing, I've been doing this close to 20 years, studying investments, but more importantly, studying investors. When you look at the investment returns, unfortunately, the investor, us, do not achieve the appropriate return that the investment is giving us. Why is that? It's because we buy and sell at the wrong time all the time. That's the financial focus today. Hey, when you take a look at studies, there's been study after study that the overall stock market over the last 20 years has produced about a 9% annual rate of return. But the average equity investor, all of us, we do something significantly less. It's close to 3%. That's a 6% differential. You could have the best portfolio in the world, the best portfolio, but one simple mistake will blow out all of that return because of our emotion. Let's bring in the big man, Big Al Clopine, to dive in a little bit deeper. Alan, emotions play a key role in success or failure of someone's overall financial goals, but time and time again, it seems like that emotion really takes a toll on us.
You are right about that, Joe. And it's like we can learn what to do, but to actually execute and do the right thing,
that's a totally different thing.
That's a whole different matter. And really, Joe, when you think about it, this is one of the most important topics that you'll ever hear about when it comes to financial planning and your investments and your retirement, for that matter. So today we're going to go over some of those mistakes and, more importantly, how to adjust for them. So number one would be for those that watch the market too much. Too often. You know who you are. In fact, it's probably most of you, many of you. And when you watch the market too often, you make trades too often. And we're going to talk about what that does to your portfolio. Here's a little hint, not very good. So the second thing is we are emotional over our kids. And we're constantly bailing them out. The baby boomer generation is probably doing this more than any other generation. So we're going to talk to you and tell you how to stop that if you want to. And then financial literacy. We need to learn more about what we need to do with our investments and our retirement and what's possible. And I'm going to ask you a simple question. See if you get it right. It's pretty easy. But about half of you are going to miss it, at least based upon a survey. And then finally, let's put together a roadmap so that you know exactly what to do in retirement. And Joe, it's probably the roadmap. That's the thing that a lot of people don't have. I mean, study after study, it's 5, 10, 20% of the people have a roadmap. Almost no one else does. And it's like, how do you go somewhere? How do you find your location? How do you get there if you don't know the map?
Right. I mean, if we're in California and we want to go to New York, right, we basically kind of know where New York is, but if we don't have a roadmap to figure out exactly what roads to take, there's going to be detours along the way. You have to take a look at what you're trying to accomplish and making sure that you manage your money appropriately for those goals. The biggest thing with retirees, you that is watching this morning, most of you, is that you watch your money too much because maybe you're worried about running out of it. And so when you look at the money all the time, you look at the markets, then that's when we tend to make actions when we probably shouldn't now.
Well, absolutely. And we actually have a graph that will show you the more often that you trade, the worse your rate of return. And if you take a look at this is a few years ago, but you can look at the left hand of your side, and this is people that don't trade very much. And look at their rate of return. The trading is in yellow, the rate of return is in blue. Now let's progress all the way over to the other side. And number 5 is where you trade all the time. Look what happens to your return. It's not near as much. And we think that we can do better by trading, by getting in and out of the market. First of all, our emotions would tell us probably to buy and sell at the wrong times, which is number 1. Number 2 is there's all kinds of trading costs that eat up those returns. And Joe, this is a problem that for people that watch their portfolio too much, it happens all the time.
Well, here it is that you take a look at activity. The more activity that you do, the better results that you should achieve, right? So if I want to work out, I want to lose weight, the more activity, the more I get out of bed, the more I work out, I'm probably going to lose some weight. That is the opposite when it comes to your portfolio. The more activity doesn't mean that you have better results. Unfortunately, men have testosterone, so they take a look at their portfolios and they trade the heck out of it. So if you look at men versus women, both of them underperform the overall market, Sal, but women are better investors than men.
Well, they are, and you look at here, 2014, the rate of return is much higher for just the market versus men and women. And then, but women do beat men. Look at that. The women are in the yellow, the men are in the blue. And then what about 2015? That was a down year. So the S&P 500 lost money. Men and women also lost money, but men lost more than women, again, because they're getting in and out of the market.
Right. I mean, that 50 basis points is significant over a long period of time. You know,
Yes.
It says 4.1 to 4.7. People are like, well, is that big of a deal? Yes, it's huge. If you take a look at that compounding over 5, 10, 15, 20 years, I mean, it depends on the pot of money that you have, but it could mean tens, if not hundreds of thousands of dollars of additional income over your lifetime just by gaining a little bit inch of return. I mean, portfolio managers make millions and millions and millions of dollars just to get that slight edge. So if you stop trading so much, right, hey, maybe you might have a little bit better experience and then you can enjoy your retirement. Stop looking at CNBC, stop looking at the Wall Street Journal, enjoy your time. Don't ignore your money, I'm not saying that, but the more action that you do with your money, unfortunately, the less you have of it.
Yeah, and Joe, I would say this, when you think about investing and entertainment, don't combine those together. Those are two separate things. This is from our friend Carl Richards. He draws these nice little graphs, and it shows you investing and entertainment can intertwine. It's not a good idea to get your entertainment through your investing because you will very likely make bad decisions. Go to movies, go to baseball games,
right,
whatever.
Go to Vegas, right? Spend a couple of bucks and go
Sure.
to Vegas if you want to gamble your money, right? If you're looking at your nest egg, that shouldn't be like, hey, let's have a lot of fun, honey. You know, let's gamble our retirement away. Let's
Right.
see how much money that we can make. It's that fear and greed is so alive and well that it is frightening because we continually underperform the overall markets is because here we're trying to find this holy grail, right? It's this search to find the best investment. And that search of finding the best investment is leading us to negative performance because we find this one and guess what? We're a little bit too late to the party. So maybe that's not the right investment. Let's get into this one. Oh, maybe that's not the right one. So you keep flipping and flopping and guess what? You're losing return. So if you have the right portfolio, you have a plan in place, then you can be more patient. What happened to patience, Al?
Well,
no one's patient anymore.
Not so much anymore, Joe. And really, people want to control the market, and you can't really control the market. In fact, let's talk about what you can control. You can control risk, you control fees and taxes. So risk means how much do you have in the stock market versus bonds, cash, safety, right? So that's one thing you can control. You can also control the fees. So certain types of investments are more expensive than others. And I'll give you a little tip. You want to be in a cheaper investment because you don't want to have the Wall Street making that money. It's for you. And then finally, your taxes. Don't forget taxes. Do you know when you're trading in and out of the market, it's causing you short-term capital gains in your non-retirement accounts? That's taking even more from your portfolio. So those are the three things that you can control, Joe, and people want to control the market, but it's better to understand what you actually can control.
Right. I mean, if you control those three things, right, you can control your risk, you can control your taxes, you can control your fees, you will have a better investment experience because when your stomach takes over for your head, you'll figure out, hey, you know what, I have a plan in action here. I have patience, I have confidence in my strategy. All right, stick around. We got to take a short break. When we get back, Allison Alley is going to join me. She's a certified financial planner for Peer Financial Advisors. We're going to ask her, what should you do with your money? What are some keys to make sure that you have the best investment experience possible? Stick around. We'll be back in just a second. Show's called Your Money, Your Wealth. welcome back to the show. The show's called Your Money, Your Wealth. Joe Anderson, Big Al Clopine hanging out. Good morning, everyone. Stick around. We got Allison Alley coming up. She's a certified financial planner. And we're talking about behavior when it comes to our investment decisions. How our emotion is a key component when we buy and we sell. And we're trying to help you to figure out some strategies to get that emotion at bay. Before we dive in, though, let's go to the true-false question. Let's see how you did.
When the market takes big drops, should I go to cash to protect myself from further losses?
Well, that's an obvious answer, yes. I mean, right, if the market is going down, what do most people do, Al? I mean, yeah, if you believe that the market is going to continue to go down, go to cash, right? And then when you know the exact time, right, when the market is going to rebound and go back up, that's when you buy. But it's impossible to do that. It's so impossible to do that. You can time the market once, but timing it twice is very difficult. So that's why having the appropriate portfolio is so important. Looking at how much risk that you're taking. Because if your entire portfolio is going down when the market goes down, I'm telling you this, you probably have way too much risk in that portfolio.
Yes, Joe, I would agree with that statement, and I would say that's generally false to get into cash. So what are you doing? You're locking in your losses, right? And so we know from the last segment, in 2014, the market gave us about 12%, the S&P 500. We know that women earned about 5% and men earned about 4%. Why is that? Because they're buying and selling at the wrong times. They panic. When the market goes down, they go into cash. It's generally not a good idea unless you know exactly when to get in and when to get out. And so far, all academic research and studies tell us that that really doesn't work. So I guess with that, Joe, we got a kind of a fun segment here where we ask you a question on video. Client asks you a question, and then you got 60 seconds to answer it, even though it may take you hours. So let's see if you can do it.
How to leave the money to my kids without them paying taxes.
All right, I believe the question was, how do I leave assets to heirs without paying taxes? Well, there's a lot of things here. A couple of things to consider when it comes to taxes at death. Let's say you have real estate. Let's say you have stocks, bonds, mutual funds. Any asset that is held outside of a retirement account, they have a step up in tax basis. So what that means is that when I pass away, the heirs are going to get an automatic step up in cost basis. So they can sell the asset the next day and there's not going to be any tax due as long as that estate is under about $5.5 million. Now, when it comes to retirement accounts, some people get confused here. So you have a 401k, an IRA, or whatever defined contribution plan that you have. So when you pass away there, there's always going to be income tax. It's called IRD tax, income in respect to the decedent. However, there's ways that you can stretch out that tax liability by setting up an inherited IRA. That's what you have to do to save money in taxes at death. Boom.
Not bad, Mr. Anderson. So, and I'll just add, that's a very important concept. Now, so just to summarize, if your estate's under about $5.5 million, there is no estate tax for the kids. And if you're married, you can double that up. But when the kids get your IRAs, your 401ks, they're going to pay tax on that just like you would have. So there are strategies right now to do some Roth conversions to get that money in tax-free, because when your kids inherit a Roth IRA, it is 100% tax-free. I know this stuff is complicated, and people ask us all the time, what can we do to make sure we're on track for retirement? So that's why we're offering today a free financial assessment. We'll give you 2 hours of our time, 2 different meetings. We'll show you exactly what to do to get on track or tell you that you are on track and give you the strategies to put you in a better spot. So this is, I think the number's on the screen, 888-99-GOALS. It's a great thing for you to find out where you stand. So I'm actually pretty excited right now because we have one of our premier financial advisors at Pure Financial, and that would be Allison Alley.
We have Allison Alley. She's a certified financial planner joining us, and I want to first of all thank you for joining.
Thanks for having me.
And then, I don't know if you saw that study, but if you take a look, is that women actually perform better than men when it comes to overall performance in the stock market. Did you know that?
I was slightly aware of that, yes.
So let's talk about that for a minute, because I think when we talked about this a little bit earlier, that activity people think means higher results, right?
Sure.
So the more that you get in and out or trade, and when the markets get a little bit funny, we have to react to them. I'm not saying go blind, but what are some of the things and strategies that you're helping your clients with?
Well, you just have to focus on doing your best to take the emotion out of it, right? And like you mentioned, the women investing and having slightly better results than men. Neither group does particularly well when on their own, but that small difference over time can make a huge impact. It's just being patient and not having those knee-jerk reactions to the daily fluctuations in the market.
But it's very difficult to do that.
Yeah, absolutely.
As you get closer to retirement, as you know, their clients are looking at their investments because that has to create an income for them.
Yep.
Right? I'm 65 years old. I'm going to live for 20 years. I need to create an income, a paycheck, every single month for the next 20 years. What's that? 240 paychecks or something like that.
Right.
So they have to take a look at their assets. And when the markets go down, the only knee-jerk reaction is to get out.
It is. So it comes down to creating a plan, implementing it, and then sticking to it. Like you mentioned, you have to figure out how much income do you need your assets to produce to sustain your lifestyle throughout retirement. Once you've figured that out, then you can determine what type of rate of return you actually need from your portfolio. You don't want to take on more risk than is absolutely necessary.
Yeah, that's easier said than done there too,
Sure.
right? Because I think too is that if people would look at their goals first, right?
Yeah, you have to.
Instead of saying, hey, let me try to get the best return possible, or let me try to find the best investment possible, because there is no best investment.
Right.
The best investment for me might be the worst investment for you.
Completely different for someone else. Yeah, exactly.
I'm sorry, go ahead.
No, I was just going to say, no, you're exactly right. And because there is no perfect investment, that's why you really have to focus on what your goals are. If you only need a certain amount of income, then there's no need to shoot for the stars, because the opposite effect of that is you can see a really large downturn that you just may not be able to afford if you're approaching retirement.
You know, we're talking about behavior when it comes to overall investing, and then that's one of the pitfalls that people make. And another one is when we're talking about emotion, kids get in the way too. The money goes kind of everywhere else but someone's overall retirement. Most people that watch this show are called the sandwich generation, right? They have elderly parents that they might still have to care for, and they might have kids still on the payroll.
Yep.
And so the money's going every which way but their overall retirement. So there's a lot of different factors that people got to take a look at.
A ton of different factors. And keep in mind, we run into clients a lot of the time that they are really focused on wanting to make sure they're taking care of college for kids and things like that, which we definitely understand. But keep in mind, if you're not focused on funding your own retirement, no one else is going to fund it for you.
You can't take a loan for retirement.
Right. You can take a loan for college, right? Your kids can still go to college even if you haven't set aside money for them. But if you haven't set aside money for your retirement, you can't retire. So you just have to kind of put that in perspective.
Well, I guess if the kids go to a really good school, they get really good jobs.
Maybe they can take care of you later.
And then they're going to take care of
Sure.
you later.
I guess that's one plan.
That is a financial plan for some people. Any final thoughts?
No, again, it's just trying to take that emotional aspect out of the whole situation, right? Get a plan, stick to it so that you have the best chance possible of achieving those goals.
Allison, where can people find you if they need your help?
Well, you can always come see me at Pure Financial.
Pure Financial, purefinancial.com. Hey, Al, we're talking about investing, we're talking about emotions, we're talking about behavior, and then the kids get in the way too a little bit there, bud.
Well, they do. We're talking about emotional mistakes, and so we all love our kids, right? And as when they become adult children, we still love them just as much. We want to help them. That's kind of our nature, but we're helping them too much. In fact, in a recent survey, we found out that about 43% of folks are legitimately concerned with their child's financial well-being. And about 37% struggled in the past and don't want to see their children struggle. And 32% the children, they feel like they're worse off than they were when they left home. So they feel like the parents are feeling like they really need to help their kids out. And it's kind of symptomatic of where the baby boomers are, which I'm one of, and I understand it. As Joe, he always gets on me because I've got my kids on my cell phone plan, the family plan, and car insurance, and but it's best not to do that. It's best to kind of cut ties as quickly as you can. So we've got a little outline for you in terms of of what you actually can do to kind of get your kids off the payroll, if you will. And the first thing you want to consider really is understanding your child's needs and concerns so that you can start to figure out where they're at, what sort of plan that they need to make. And the second thing would be establishing a plan. Establishing a plan is going to be, how can I get this kid off my payroll? How can I get them self-sufficient? Set a time limit. Charge rent if they're living at home, and if they just made some big mistakes and you feel like you got to bail them out, make sure it's very clear this is absolutely a one-time offer. So these are some steps that can help you sort of try to take some of the emotional sting out of trying to get the kids off the payroll. I will mention one more thing as well, and that is financial literacy is a big problem for those coming into retirement. There's a lot of misinformation. You're making a lot of poor emotional decisions just because you really are not that well educated. So I'm going to ask you a question right now. Let's see if you can get the question right. And it's, is the stock of a single company usually safer than a mutual fund? What do you think? Joe, what do you think?
Well, the best investment that anyone can ever possibly make is an investment in one individual stock. The worst investment that anyone can possibly make is an investment in one individual stock.
Exactly.
That's why diversification is the only free lunch. I know the answer to that, it's a mutual fund, but I would say half of people got that answer wrong.
That's absolutely right. Half did get it wrong. And when you think about it, so a mutual fund is a collection maybe of 500 stocks, 1,000 stocks. So when you have that many investments inside of a single investment, they're going to go up and down at different times. It's much safer than a single stock, which can be fantastic and it can be horrible at the same time.
Hey, we got to run. We got to take another quick break. When we get back from the break, we're going to flip the show back to you. We're going to answer your email questions. We got a great bag of emails this week, so you don't want to miss them. We'll be back in just a second. The show's called Your Money and It's Your Wealth. Hey, welcome back to the show. The show's called Your Money or Wealth. Joe Anderson here alongside Big Al Clopine. Thanks for tuning in. Good morning, everyone. Hey, we're talking about mistakes and emotions that we have when it comes to your money and the lack of a game plan. So we want to get into real briefly a game plan of what you should take a look at to see if you're on track. But before we do that, let's go to the true-false.
Buying gold is always a safe investment when the market is volatile.
Yeah.
I would say no.
Well, always.
Anytime you have always, the answer is definitely no.
Yes. I think gold is...
But why is that?
Well, first of all, gold doesn't have an expected rate of return. It's a metal, right? Stocks have expected rates of return because they produce cash flows, and you buy stock to get future cash flows. Gold is an inflation hedge. I'm sure. So when stocks go really bad, the gold bugs come out, and then they buy gold because they want those gold bricks, because they think the stock market's going to go to zero. I think commodities should be a part of your overall portfolio, but just to jump in gold when the market goes down is probably not the most appropriate strategy. What you do need, though, is a strategy, Alan, and then let's just run through what people should take a look at in regards to a financial roadmap.
Yeah, I think right off the bat, you got to identify your desired spending. What are your goals? And in this example, $90,000, that's the spending. Look at your fixed income, Social Security, pensions, and so forth, $60,000. Calculate the shortfall, subtract 60 from 90. You need 30,000 from your investments. Add up all your liquid investments, retirement accounts, investment accounts, in this case 900,000. You compare 30,000 into 900,000, that's a 3.3% distribution rate. Are you on track? Yes, I would say you're on track. A lot of experts say if you want to be under 4%, some studies say as low as 2.8%, but 3.3 is a pretty good distribution rate. There are a lot of factors depending upon your age and longevity and so forth, but yeah, that's number one. Now, that's not all you got to do. You got to also figure out, do you want to spend every last dime? Do you want to have money go to the kids? How are you going to spend your time in retirement? So there's a little bit more to it, but that's where you start financially.
Yeah, that's all you need is $900,000. You're good. 900 grand, call it good. Hey, let's go to them. Let's go to the email bag.
I'll go with that. Okay, my husband wants to use our emergency funds to help our son buy a home. All our other savings accounts are in retirement funds. We are in our 60s. We're both still working. How much cash should we keep available to us? Well, I guess that's maybe a two-part question. One is you probably want to keep 6 months to maybe even a year of cash and savings, probably at least 6 months.
Yeah, 6 months expenses,
Right.
maybe income, depending on what your fixed income is.
Right.
All right, so if you have big pensions, maybe shorter cash reserves is appropriate, but if you have to get a lot of money from your portfolio to create that income, probably a lot more. But I guess the real question there, Al, is that should they deplete their cash to help their kid to buy a house?
Yeah, and I would say no. I mean, this is for yourself. This is for your own retirement. If you deplete your cash reserves and everything else is left in your retirement accounts, that means all of your income in retirement is going to be subject to ordinary income tax, your pensions, your Social Security, and the money coming out of your IRAs, 401ks. So it's best not to use that for your kids' home.
Well, you know what? If they're gonna do it anyway, Al. So take it from cash. Don't pull it from your retirement accounts, because we've seen that mistake too.
Sure.
You pull out $200,000 in your retirement account to put a down payment for the kid, and all of that is taxed at ordinary income. So you have your income plus that distribution. Now you're paying 50% in tax. So be careful where you're pulling your money out. I guess I don't want to be a Debbie Downer and say never help your kids. That's not what the point of the show is. But you want to make sure that you have a plan in place. Take a look at what you have, what you're trying to accomplish, and come up with a plan to create the retirement income that you need, and then everything else give to the kids. All right, how about that for a plan?
There you go.
All right, hey,
that.
we got to get out of here. Thanks so much for joining us. Next week, we got a great show lined up. We're going to talk about Social Security. How do you maximize that Social Security? There's a lot of different combinations that you can choose from. A lot of them are good, a lot of them are bad. So find out the right solution for you. For Big Al Clopine, I'm Joe Anderson. You just watched another wonderful episode of Your Money, Your Wealth. Have a great weekend, everyone.